Introduction to business financing. Every business, regardless of its size or sector, needs capital to function effectively. From startup costs and working capital to expansion funding and equipment purchases, finance is the lifeblood of any enterprise. The decision on where and how to raise capital is one of the most strategic choices a business will make. This module explores the different sources of business finance, providing an in-depth analysis of each category: internal versus external, short-term versus long-term, equity versus debt. It also covers factors influencing the choice of finance, cost implications, advantages and disadvantages, and real-world considerations such as financial risk, ownership dilution, and control. Classification of business finance sources. Business finance is typically classified into several broad categories based on A. Nature of the source, internal sources, funds generated within the business; external sources, funds obtained from outside the business. B. Time horizon. Short-term finance, repayable within 1 year. Medium-term finance, repayable within 1 to 5 years. Long-term finance, tenure exceeds 5 years. C. Ownership structure. Equity, financing, ownership-based, e.g., shares. Debt financing, borrowing-based, e.g., loans. Understanding these distinctions is critical for aligning financial strategy with business goals. Internal sources of finance. Internal financing refers to funds generated from within the business, such as 1. Retained earnings profits that are reinvested in the business instead of being distributed as dividends. Advantages: no repayment or interest cost, retains full ownership and control, indicates financial health. Disadvantages: limited availability, may dissatisfy shareholders seeking dividends. 2. Sale of assets, selling off unused or redundant business assets, e.g., old equipment, real estate. Advantages: generates quick cash, reduces maintenance costs. Disadvantages: may limit operational capacity, not sustainable as a regular source. 3. Working capital management, releasing tied-up capital by tightening credit terms or optimizing inventory. Advantages: improves liquidity, requires no external involvement. Disadvantages: may affect supplier or customer relationships. External sources of finance. External financing involves raising capital from outside stakeholders. 1. Equity financing involves selling a share of the business to investors. A. Common shares, ordinary equity. Investors become part owners, receive dividends and voting rights. B. Preference shares, receive fixed dividends but usually no voting rights. Advantages: no repayment obligation, useful for high-risk businesses. Attracts investors looking for long-term returns. Disadvantages: dilution of ownership, profit sharing reduces retained earnings. 2. Debt financing involves borrowing money that must be repaid with interest. A. Bank loans, structured repayment and interest schedules. Bonds and debentures, long-term borrowing instruments issued to the public or institutions. C. Overdrafts, short-term credit lines from banks. Advantages: maintains ownership control. Interest is tax deductible. Disadvantages: regular repayments increase pressure. Risk of bankruptcy if revenue declines. Other sources of business finance. 1. Trade credit. Credit extended by suppliers allowing businesses to buy now and pay later. Useful for managing short-term cash flow. 2. Leasing and hire purchase. Acquiring assets through periodic payments rather than upfront purchase. Leasing, ownership remains with the lessor. Hire purchase, ownership transfers after final payment. 3. Venture capital. Investors provide funds to startups with high growth potential in exchange for equity. Involves mentoring, strategic input, and significant influence. 4. Government grants and subsidies. Non-repayable funds or tax incentives to encourage specific business activities. Available for Startups. Women, youth entrepreneurs, R&D initiatives, limitations. Eligibility criteria, long approval processes 5, crowdfunding. Raising small amounts of money from a large number of people via online platforms, e.g. Kickstarter, GoFundMe. Types, period. Donation-based, reward-based, equity-based. Choosing the right source of finance. Selecting the appropriate source of finance involves analyzing the business's A. Stage of development. Startups. May rely on equity, crowdfunding, or grants. Established firms can access bank loans or issue bonds. B. Amount needed. Small amounts, 0. May be raised internally or through overdrafts. Large amounts. May require equity or long-term loans. Cost of capital. Debt has interest cost but no dilution. Equity has no fixed cost but requires sharing ownership. D. Risk appetite. High-risk businesses may struggle to access debt. Equity investors may demand higher returns. E. Repayment capability. Businesses with steady cash flow can manage loan repayments. Unstable income may be better suited to equity. F. Control considerations. Entrepreneurs may avoid equity financing to retain control. Debt financing ensures control but increases financial burden. Real-world applications and case examples. Example 1: Startup. An agritech startup needs 10 million naira to develop its app and onboard users. The founder considers 2 million naira from personal savings, internal. 3 million naira from angel investors, equity. 5 million naira from a development grant. Result. The startup preserves cash flow and avoids debt early on. Example 2: Expansion finance. A mid-sized furniture manufacturer wants to build a new production unit. Equity, not willing to dilute ownership. Decision. Takes a 5-year bank loan at 12% interest. Result. Gains new facility while retaining control. Pros and cons of equity versus debt financing. In this course, we will be using criteria, equity financing, and debt financing in this course. First, repayment obligation. Number, yes. Second, ownership dilution, yes. Number, third, tax benefit. Number, interest is tax deductible. Quota risk, shared with investors. Business bears all repayment risk. 5. Control, reduced. Investors may seek board seats. Full control retained. 5. Cost of capital, generally higher, higher required returns. Generally lower, interest rates. Summary and conclusion. Accessing the right type of business finance is a balancing act. Entrepreneurs and financial managers must weigh the cost, control, risk, availability, and long-term goals of their business before selecting a source. Misaligned finance choices can lead to cash flow challenges, over-leverage, or ownership loss. A strategic mix of internal and external, short-term and long-term, debt and equity ensures businesses remain financially healthy, agile, and growth-focused. The knowledge from this module empowers decision-makers to identify appropriate financing options tailored to specific business needs and economic contexts.